I'm delighted to introduce you to Cesar Arias, who's Director of Public Credit at the National Treasury at the Ministry of Finance in Colombia. So my first question is for Cesar and Fayaz. In fact, it's the same question that I would like to address to you both. Climate change is really a problem of the global commons, that is the resources that we all need to survive and prosper universally. And yet we're asking countries to put in place national policies and take measures that affect local communities. So where do sovereigns need to act unilaterally and where do they need to coordinate more internationally? So perhaps Cesar can go first and then Fayaz. The floor is yours. Thank you, Cesar.
Thank you, Carmen, and good afternoon to everybody. Thank you for this invitation to PRI. Let me make 2 points. I think that in order for ESG policies to be effective, they have to be legitimate. And the Colombian approach to guarantee that legitimacy has been to transform ESG into a policy, into a state policy, beyond a government policy. So in our view, ESG policies have to survive 2 tests. 1, the test of Congress, and 2, the test of the market. And that is the reason why we have gone to Congress with 5 laws. First, in the public borrowing law, we incorporated the need to be rigorous in the frameworks for thematic bonds. But going deeper, we also passed a law for environmental crimes. We also passed a law for clean transportation, a law for energy transition. And this month, we're actually filing our last law because we're getting out of government next year, which is the Climate Change Action Law. But laws are not enough. You have to deliver results. And based on the spirits and policies in these laws, we have been able to reduce deforestation by 20%. We have increased through tax incentives and other fiscal incentives tenfold in the purchases of electric vehicles in Colombia. And we're moving from a alternative non-conventional energy in our energy matrix from 0.2% to 14% in 4 years. But the second thing is that you have to survive the test of Congress, of the market. And we have launched 2 policies. First, sovereign green bonds with a twin structure like Germany that we launched 2 weeks ago with very strong results that we can discuss later. And second, we also publish for public commentary the Colombian green taxonomy that we can also comment further later.
Before we move on, I just would like to spend a couple of minutes asking again, Cesar and you, Fayaz, if you can explain a little bit more what is the role of the coalition of the finance ministers for climate action, because perhaps it's less well known to the wider audience than the network for the greening of the financial system of the central banks. It was created 2 years ago, but its activities are not that well known. I know I mentioned earlier that you're guided by 6 principles, the Helsinki principles, and I'll read them aloud. They're align, share, promote, mainstream, mobilize, and engage. So quite a lot on the plate. So which of these, starting from Cesar, which of these do you think are the most challenging ones to implement from a Ministry of Finance point of view, and which are the quick wins? And but before you start, Cesar, let me say that I'm very pleased to see that more and more ministries of finance are involved in this conversation, because incidentally, we see the same thing on the corporate side. Initially, we were only talking to sustainability officers and ESG analysts, and now more and more we're talking to the fixed income portfolio managers and the credit analysts. So it's great that this initiative of the coalition of the finance ministers is up and running as well. Over to you, Cesar.
Thank you very much. This is a great question. So definitely the coalition of ministers of finance helped with the Helsinki principle engage. But I want to focus my remarks on the most challenging principle, which in my view is principle number 5. mobilize. We all know that in the Paris Accord, there was a commitment to raise $100 billion per year from the developed markets to the developing markets. And from 2016 to 2019, 288 billion had been raised, but there is a gap still to fill of $112 billion, particularly dedicated to emerging markets and developing countries. I have two ideas that can contribute to this debate. The first one is further develop what we all sign in the Paris Accord as the Paris Rules Book. Article 6 says that we need to develop a system of carbon credits across countries. And let me use one metaphor, Carmen. If we were able in the G20 to set a minimum corporate income tax for corporates worldwide, I think in the COP26, we can have a discussion of a universal carbon price in developed and developing countries, because the range is very different. In my country, it's $5 a ton. In your countries, it's closer to $70 or $60 a ton. And that creates a lot of inefficiencies in the market development. And finally, my second contribution will be, I was inspired by the speech of Janet Yellen, the Secretary of the United States. And she says that no amount of public financing will be able to fully cover the gap to meet our environmental commitments. And she made a call that is necessary to bring in equity. So here in the DMOs, a lot of people approach us to offer debt. But I think that we have to be innovative and also crowd in equity from the private sector to meet these challenges.
Can we stay for a moment on this topic of the diversity of countries and how the sustainability challenges affect them in different ways? Because I heard earlier Cesar saying there is a big difference in carbon pricing. It struck me that he said in my country and in your countries, so there is a big divide. And then I heard Peter talking about sovereign rankings, which actually could penalize certain countries when investors adopt a screening approach when they construct their portfolios, or a best-in-class approach. So in particular, I'd like to hear your views about how can we ensure that this more systematic consideration of ESG factors in the analysis of sovereign debt and just sovereign policies in general doesn't penalize emerging markets that are more exposed either physically or because of the cost that they have to sustain to meet the challenges of the transition than developed countries. So how can we assure that they don't get penalized?
Sure, Carmen. This is a very interesting topic. And I think that what we're trying to position into the minds of policymakers, multilaterals, and the market is the notion of cleaner investments. And there are significant nonlinearities here. We're fully convinced that a dollar that you invest in Colombia is significant higher in terms of impact than a dollar that you can invest in some other places. Why? Look, Colombia is the second most biodiverse country, and it is responsible for less than 0.5% of the greenhouse emissions globally. 35% of our territory is Amazon, and 50% of our territory is tropical forests. We have 59 national parks. Our national park system is the size of Ecuador. So what we are saying is, instead of penalizing countries because we export oil, which is already incorporated in the ratings, that's called commodity dependence, well, you can also align incentives and award countries that are contributing greatly to biodiversity protection and climate change mitigation in the world. That goes beyond Colombia itself, but it also has positive externalities for the world.
Actually, I want to ask Cesar, to the point that Peter has raised about collaborative engagement. Do you think that's useful from your point of view, aside of the Colombian DMO, that in terms of does it save you time and you can address the same question more efficiently to a group of investors, or is it better to have one-to-one engagements, or where do you strike the balance?
I think the answer is transparency, transparency, transparency. Whatever you produce that is sound and robust, either is data, satellite from reforestation, or water management systems for cleaning your sewage, we have made an effort to put this first in the website so that people can track it. And second, I think that you have to make an effort to communicate. And there are different types of communication. You can do it one-on-one, you can do it in small groups, or you can do it in big forums like this. So I think that sovereigns require a comprehensive strategy for both transparency and communication with investors, with rating agencies, and with all the stakeholders that we have. So I think you have to use all of them.
I heard Cesar talking earlier about transparency as being key in the communication with investors. What other tools can we use to promote a culture of engagement with sovereigns as opposed to divestment? Because we hear lots this talk about divest from sovereigns, that could pose a threat, but equally divesting from sovereigns if they have high sustainability challenges and they're not addressing them risks depriving sovereign markets, especially emerging markets, from much needed capital. So what other tools could we use to promote that culture of engagement as opposed to divestment?
Yeah, I would mention two instruments that are very helpful for engagement with the market. The first one is policy-based lending. We are big users in Colombia of this. And this has several advantages. First, the multilaterals ask you for their reforms upfront before you can access the disbursements. Many of those laws that I mentioned, Clean Transportation Act, Energy Transition Bill, Public Borrowing Bill, were preconditions for accessing capital at favorable terms. That's one advantage. Second advantage, the private sector can also sort of engage with multilaterals and, provide capital to particular sovereigns or corporates based on this analysis of upfront policies. I like to mention an example that I used in the past, and is that in order to protect the Amazon, the most important investment that you can do is in police forces, because the bigger enemies of the Amazon are the smugglers or the illicit crop activity. When you access this type of loans, policy-based loans, you do your reform first, but then you have flexibility to use the resources in the best topics that you want to use them. And the second instrument that we have used is the twin bond structure, because it provides transparency on the so-called greenium. When we launched our sovereign bonds last month, our greenium was 7 basis points. Today, that greenium has expanded to 16 basis points based on this performance of the bonds. But I also want to throw an idea. The same way that we have step-up coupons for sustainability-linked bonds for corporates, I think that we can envision a step-down coupons for sustainability-linked bonds for sovereigns, because that aligns incentives between the issuers and the investors and can promote that sovereigns outperform their targets in order to get access to more competitive financing.